Hi everyone. So after doing financial management, the aims and of financial management, definition of financial management, and which is a cheaper source of financial management when we talk about the finances or business finance, we come again to the objectives of financial management. The definition here, it says it is concerned with optimal procurement as well as usage of finance. So you get finance from somewhere, you get money from somewhere, and how you use it is what financial management talks about. The next is objectives of financial management. When we talk about objectives of financial management, I have given it an acronym called SUMS. First one is sufficient availability of funds. Now, for example, I need some kind of money. I need some kind of money means I need money for some particular business purpose, and the fund is not available with me. So I go and ask one of my friends to lend me money. He says, come tomorrow morning. Probably that deal will not get finalized if I take it to the next day morning. I need money right now. Right now I need money, and I am asking my friend. If my friend gives me money and does not charge me rate of interest very high, or charges or does not charge at all, will be a good idea. But if the money is available next day, and that particular deal where I had to pay a signing amount as a money, it is not, I am not able to crack it, it is of no use. The money getting next day morning is of no use. So sufficient availability of funds. Funds should be made available to you whenever it is required. Second, utilization of funds. Don't put your money into idle funds. Idle funds, I gave example. Don't keep them at home. Don't buy too much of gold and silver when you're into business. Don't buy property which would not be in use later on. Why? Because you buy property today expecting an appreciation in the value of the property, but there's a possibility that there is no appreciation and the property sometimes depreciates, or you may not be able to sell it, and then you have to sell it at a lower price. It becomes a problem. So properly money should be used. It should not be misused. No over capitalization, no under capitalization, no over expenditure, no under expenditure. Maximization of owner's wealth. Now this is the primary or the primary aim of financial management. This is very essential to know what is primary or the major aim of financial management. It says maximization of owner's wealth. Now let's get few things very clear. In an organization, the owner, what belongs to owner? The equity shares belong to the owner. And when he borrows money, he may borrow from the bank, he may borrow from the other sources. He may also invite some people to put debentures in his company, to buy the debentures of his company. There could be some creditors also. There could be invariably many people. Now what happens is, when we talk in terms of cost, we say debt is a cheaper source of finance. Good enough. When we talk in terms of returns, we say, okay, we should get more returns. So whenever in an organization, the equity shareholder gets more return and he is able to, that is, he is able to get, he's getting more money and he's able to pay off the creditors, pay off the debenture holders, that is their rate of interest, pay off any kind of other expenses which he had to go through, and then still he has money to reinvest or to pay to the shareholders, that is the equity shareholders. That means his wealth is maximizing. How? I'll let you know. See, suppose in a company, this is your equity shareholder and this is your debenture holders, right? These are your debenture holders. Now, whenever company earns profit, first of all it pays to the creditors, then it pays to the debenture holders, or maybe first to the debentures and then to the creditors. Who are the last one to be paid or last one to receive money or last one to get that kind of profit? The equity shareholders. After paying off all the people, if equity shareholders are getting value for their money, it means that they are able to maximize their wealth, leading to maximization of owner's wealth. Next comes safety of funds. When we talk about safety of funds, I always say that safety of funds exactly means nothing else but please do not misuse your money. Keep your money safe. Don't put it into the wrong ventures. The moment you put the money into the wrong venture, it creates a lot of problem. So objectives of financial management: sufficient availability of funds, utilization of fund, maximization of owner's wealth. This is the primary aim. You can get it as an MCQ. And safety of funds. 4 things we have to do when we talk about the objectives of financial management. Next we come to is financial management is concerned with solution of three major issues relating to financial operations of a firm. Financial operations, okay, in a firm or of a firm, corresponding to three decisions. When we talk about these three decisions, these are nothing else but financial decisions. So this is the definition for financial decision. What does it say? It says that in any organization, you need to have three major decisions to know or to know about how you're utilizing your finance, or to know how to put the funds in the right use. Exactly, financial management is concerned with the solution of three major issues relating to financial operations. Operations means working, corresponding to three decisions. What are the three decisions which we are talking about? First is investment decision, the second is financing decision, and the third is dividend decision. Let's talk about investment decision first. What does it say? Investment decision relates to how firms' funds are invested in the different assets. In different assets means long-term assets and the short-term assets. When we talk about long-term assets, we are talking about capital budgeting decision. When we are talking about short-term assets, we are talking about none other than our working capital decision. Okay, capital budgeting is fixed capital, management of fixed capital. It is also known as management of fixed capital. It involves basically when you talk about or when you try to understand long-term assets, you're talking about involves committing of finance on a long-term basis. Now, when you put your finance for a very long-term basis, more than 5 years, it is long-term assets like making investment in new machine to replace an existing one. So when your machinery gets obsolete and you replace it with a new one, that's a very, very long-term asset decision. Now, short-term is also called working capital, like I told you, is concerned with levels of cash, inventory, bill receivables which you have. So when you talk about working capital is required for doing that day-to-day kharcha, day-to-day expenses. You need cash, and sometimes you have debtors, then you have sometimes you have inventory. All these are, this is what constitutes of working capital decision. So out of the three decisions, first is investment decision. There are some factors to be done and there are some questions to be done on the investment decision. To it will come to later on. Till now, investment decision. Alright, so to continue with the long-term assets and the short-term asset, we are going to talk about what exactly are long-term assets or the capital budgeting decisions. When are they good and how do they ruin the financial fortune of the company? So when you talk about the long-term assets or when you talk about capital budgeting decision, it's very important to know that capital budgeting decision involves huge cost. One, these decisions are irreversible. You take these decisions and you cannot reverse them until unless you incur a huge loss. Like for example, a huge cost rather. For example, you start a business of 1 crore of rupees and next day morning you want to sell that business to somebody else. Nobody is going to buy it in 1 crore. It is going to sell off at a lesser rate. So it's huge investment. You cannot just immediately reverse the decision because it's an irreversible decision, and moreover, a lot of risk is involved, profitability it affects. So you have to take this decision carefully. If you are not careful, the financial fortune of the company can be ruined anytime. So when we talk about long-term assets decision, these decisions are very crucial for any business since they affect the earning capacity in the long run. Of course, they talk about the profitability. The size of assets, profitability are affected by capital budgeting decisions. So these are another things which are affected by it. A bad financial decision may ruin the financial fortune of the organization or for the company. These decisions are very crucial to business because of the following reason why they are very crucial. These involve huge amount of investment. So first is a huge amount of investment. Second, these are irreversible. One cannot wriggle. Wriggle means come out of them except with a huge cost, and they need to be taken up with lots of care because they involve lot of risk. Risk is involved. They involve lot of risk. Now, whereas the short-term decision, what are the things apart from what we have already discussed? These affect day-to-day working of business. We know it. We are talking about working capital decision. They also affect, so these affect day-to-day working of the business. They also affect the liquidity as well as the profitability. Of course, yes, liquidity and profitability. How? Now, working capital decisions, we talked about the stock, inventory, we talked about debtors, we talked about bill receivable. Easy convertibility into cash is what is liquidity. So, the more liquid cash you have, of course, it is easier for you to circulate your funds. The easier to circulate your funds, the easier to invest in your business and earn more in comparison in return. Rather than borrowing from anyone else, using your own money instead of keeping that money with someone else for a longer period of time, like if you give it to a debtor or a customer, a longer duration of credit terms. So if you give like that and the money gets stuck there, or your bill receivables are for very longer time, then it's not a very appropriate idea or a very beautiful idea. So essential ingredients of sound working capital are what exactly? What are the ingredients of good working capital? First, efficient cash management. Cash should be managed properly. There should be no wastage of cash. Inventory management, they should not be overstocking or understocking. That means what? Your stock should not be kept idle, because if it is just kept in the go down, your capital get tied with it and the stock is also not being sold. Yes, you should be ready with whenever the demand arises. Enough of stock should be there, but then you should have enough of time to complete the demand also. Overstocking should not be there, so that the capital gets blocked there. And receivables, when you talk in terms of receivables, you're talking in terms of the bill receivables. Now, once we finish off with the topic, the long-term assets, once we finish off with this topic, the long-term assets, we're going to come to the topic factors affecting investment decision. What are the decisions which actually affect the investment decision? How do you take the investment decision? Why long-term asset, short-term asset really make a difference? And what are the factors which could actually affect? So the first factor, I made a flow chart out here. It's easier to learn and remember and to know about the particular topic. Cash flow of the projects. Now for cash flow, there are two things. You have inflow or you have outflow. Long-term assets and short-term assets, any of the decision, capital budgeting decision, I will take only long-term asset decision, I will take only when I have more of receipts and less of payment, because I don't want to add up another burden of paying interest to anyone along with already increasing kharcha if I have more outflows. So cash flow of project over the life of an investment. So if you're investing something or if you're putting your money into long-term asset and in that particular project you have more inflows, it's a good decision. But if you have more outflows, payments are more, in that case you cannot risk out for too much of capital budgeting decision. Why? Because you know it that you'll add up the kharcha there, you'll add up your expenses there. Next, rate of return of the project. There are two projects, the project A or project B. Project A has 10% rate of return, project B has 12% rate of return. Of course, which has more rate of return is a better project anyhow. So always for our benefit, for getting more returns, always that project will be preferred which has got more rate of return. Rate of return means we are talking about the profit. Next, investment criteria involved. When do you invest? How do you invest? What do you keep in mind while investing? So when you make the investment decision, what you keep in mind is two things. You make calculations about the amount of investment, interest rate which you have to pay. Of course, you would not receive interest for investing into a project. Cash flows in terms of inflow and outflow both, rate of return, that is the profits which you are getting. So you make your calculations, like you will be doing your gross profit, net profit ratios and all those techniques you have. Then you have techniques of internal rate of return, profitability index. There are many techniques are there. You need to keep in mind the techniques to calculate these things, and once these techniques are finalized and they give you the right kind of projection of which project is better for you, then only you take up the project criteria. So these are two actually techniques are applied to choose the best project. We apply the technique to make calculation about the choice of the project. Now this was about investment decision. Next topic we'll take up is importance of investment decision or importance of capital budgeting decision. After that we'll be talking about financing and dividend decision. Once we finish off with the decisions, then we're going to talk about, of course, with the factors, then we're going to talk about the next very major important topic of this chapter, that is trading on equity or financial leverage. Till then, enjoy yourself.